About 45 years ago, the United States had a problem. Inflation was running at nearly 15%. Every grocery trip cost more than the last. Gas lines stretched around city blocks. People were watching their savings get eaten alive, and nobody could explain why working harder wasn't helping. Sound familiar? The Federal Reserve's response, what they decided to do next, triggered one of the most significant wealth transfers in American history. Some ordinary people came out of it richer than they'd ever been. Most people came out of it exactly the same, or worse. The difference wasn't income. It wasn't timing. It was understanding what was actually happening, and making one or two specific moves before the window closed. That window is open right now. And in this video, I'm going to show you exactly what it looks like. Animated rate chart, 1979 line climbs steeply to 19.1%, labeled, brief pause at peak starts declining. Text on screen, sound familiar? Wipe to 2022 to 2026 chart showing same shape at smaller scale. Now, before we go any further, I want to be clear about something. I'm not your financial advisor. This isn't financial advice. What I'm doing in this video is showing you historical data and what it has meant for regular people's finances in the past. What you do with it is up to you. But here's why I think this matters right now. Specifically, the Federal Reserve just held interest rates at 3.75%, after cutting them 6 times over the last 18 months. Goldman Sachs expects 2 more cuts this year. JP Morgan thinks the Fed might not cut at all. Nobody agrees. And in that uncertainty, there's a playbook. It's been used before. And if you understand it, the next 12 to 24 months look very different than if you don't. Let's start with what's actually happening. Clean text on screen, Fed funds rate, 3.75%, March 2026, 6 cuts in September 2024, total reduction, 1.75 percentage points. Here's the situation as of today. The Federal Reserve's benchmark interest rate, the federal funds rate, sits at 3.50% to 3.75%. That rate peaked at 5.25% to 5.50% in July of 2023, after the Fed spent 2 years hiking aggressively to fight inflation. Since September 2024, they've cut 6 times. A total of 1.75 percentage points. And here's the thing most people think, they hear, Fed rate cut, and they think, great. My debt is cheaper. My mortgage is coming down. Relief is coming. Here's what actually happened. The average 30-year fixed mortgage rate is still 5.98% as of late February 2026. That's almost exactly where it was before several of those cuts. Because here's what the Fed doesn't control, mortgage rates track 10-year Treasury yields, not the overnight lending rate. The Fed can cut all it wants. Mortgages answer to the bond market. And credit cards? The average credit card interest rate is 23.79%. As of January 2026. After 6 rate cuts. Think about that for a second. The Fed cut rates by 1.75 percentage points, and credit card rates dropped by less than 1 point. That asymmetry is not an accident. We'll come back to that. Because it's one of the most important things you need to understand about how money actually works. The Fed cutting rates does not automatically mean your debt gets cheaper. Banks decide how much of that cut they pass through, and they're choosing not to. To understand what to do now, you need to understand what happened then. It's 1979. Jimmy Carter appoints Paul Volcker as Fed chair with one mission, kill inflation at any cost. Volcker raised the federal funds rate to 19.1%. 19%. To put that in today's terms, imagine paying 19% annual interest on your savings account. Or 19% on your mortgage. He held rates there as the economy buckled. 2 back-to-back recessions. Unemployment hit nearly 11%. Factories in Michigan, Ohio, and Pennsylvania closed permanently. And those who borrowed heavily during the boom, small businesses, farmers, were the ones destroyed when credit dried up. Then, in 1982, Volcker started cutting. And here's what happened to the people who understood what was coming. Those who had put their money into high-yield CDs in 1980 and 1981, when money market funds were paying 15 to 18% annually, locked in those rates for years. Literally years. While everyone else chased lower and lower returns as the Fed cut, they were still collecting double-digit interest on money they'd parked years earlier. People who owned long-term bonds before Volcker started cutting saw those bonds appreciate significantly in value. When rates fall, bond prices rise. It's a mathematical relationship that never changes. And people who carried variable rate debt into that high-rate environment, credit cards, adjustable mortgages, paid for it in a way that took years to recover from. In a rate-cutting cycle, the people who act early, locking in high rates, attacking variable rate debt, consistently outperform the people who wait. The people who got hurt most assumed the high rates would last forever. Today's situation is not identical to 1982. I want to be honest about that. Rates peaked at 5.5%, not 19%. The cutting cycle is shallower. The economy is not in the same kind of structural collapse. But here's what is rhyming. The Fed has pivoted from hiking to cutting. It happened in 1982. It's happening now. High-yield savings accounts and CDs are still paying genuinely attractive rates. Right now, you can find a high-yield savings account paying 5% annually. A 2-year CD at 4.5% or higher. But Bankrate's latest forecast says those top rates are heading to 3.7% by the end of 2026. That's a 26% drop in the passive income your savings earns. And Americans are carrying $1.277 trillion in credit card debt at an average of 23.79% interest. That's a $507 billion increase in just 5 years. Here's what the people who got hurt in 1982 had in common: they assumed the system would take care of them. They waited for rates to come down naturally. They kept carrying variable rate debt thinking the Fed would fix it. What the Fed actually does is set a price. The banks decide what they do with it. And banks have a very consistent track record: when rates go up, they pass it to consumers immediately. When rates go down, they take their time. That's not conspiracy. That's business. Here's the thing that nobody says out loud. The Federal Reserve cut interest rates 6 times. Your savings account rate is quietly being reduced. Your money market fund is earning less. But your credit card rate has barely moved. This is not a glitch. This is the model. Banks are allowed to be asymmetric. When the Fed hikes, they immediately raise credit card APRs, they capture that spread instantly. When the Fed cuts, they lower those same APRs as slowly as legally permitted, preserving as much of that spread as possible. The Federal Reserve gave you 6 cuts. Your bank gave back less than 1. That $507 billion in additional credit card debt Americans accumulated in 5 years. It's being charged at 23.79%. That's roughly $120 billion per year in interest payments, from American families to American banks, on debt they accumulated trying to survive an inflationary period. The Fed's cuts were not designed to help you. They were designed to stabilize the banking system and stimulate borrowing. Whether you specifically benefit depends entirely on what you do in the next 12 to 24 months. Side-by-side graphic, left, what banks did when rates went up, immediate pass-through, bar goes up fast, versus right, what banks did when rates went down, slow pass-through, bar barely moves. Source: Federal Reserve/Lending Tree Data 2024 to 2026. Let's bring this together. The Federal Reserve is cutting interest rates, and depending on how that plays out in 2026, it could quietly help you or quietly hurt you. Here's what history tells us to do: first, lock in higher yields before they disappear. The top high-yield savings accounts are still paying around 5%. A 2-year CD will lock that rate in even as the Fed cuts further. If you have savings beyond your emergency fund, consider moving them into a CD before the next cut. The 1982 lesson: the people who locked in early captured years of superior returns. The people who waited chased the rate down. Second, attack high-rate variable debt aggressively, now. Paying down $5,000 in credit card debt at 23.79% is the equivalent of earning a guaranteed 23.79% return on that money. There is no legal investment that matches that on a risk-adjusted basis. Don't wait for the Fed to fix your credit card rate. They already cut 6 times and it barely moved. The 1982 parallel: those who carried variable debt into the rate cycle paid for it for years. Third, understand what the Fed actually controls, and what it doesn't. Mortgage rates track the 10-year Treasury, not the Fed funds rate. If you're waiting for the Fed to bring down mortgage rates, you're watching the wrong number. Watch 10-year Treasury yields. Refinancing decisions should be made based on where Treasuries are going, not what the Fed says at press conferences. If this video changed the way you see how interest rates actually work, subscribe. I publish 2 videos a week on the financial patterns they don't teach in school, the ones that tend to matter most for people between 25 and 45 trying to actually build something. The next video in the queue covers what I think is the single most overlooked financial risk of 2026. I'll link it right here.